Welcome to Breaking News to Trading Moves. Today we're looking at a transaction that really gives us an X-ray view into the future of active asset management. We are talking about the buyout of Janus Henderson Group.
That's right. The headline here is that Nelson Peltz's Trian and General Catalyst have agreed to acquire Janus Henderson Group, ticker JHG.
And this deal, coming from private capital, it offers a really clear snapshot of the pressures on traditional financial services. So our mission here is to look at the available information and pull out the clearest picture of who might benefit and who might face some new challenges because of it.
Let's do it.
Okay, so let's start with the hard numbers. What did Trian and General Catalyst put on the table?
It's an all-cash deal. They're valuing the whole firm at about $7.4 billion.
All cash. And the share price?
They're paying $49 per share. And to give you some context, that's an 18% premium over the closing price on October 24th, 2025.
And that date is key because it was the last day before any news of the deal started to leak out, right?
Exactly. The last unaffected close. So a genuine 18% premium.
That feels like a lot for an active manager in this environment. So the timeline, they're expecting to close by mid-2026.
Yes, and Ali Dibadj, the current CEO, is expected to stay on.
Okay, so they pay a premium and they keep the current leadership.
Right, and that really is the main point of this whole conversation. It tells you this wasn't some kind of distressed sale. This is a strategic bet.
A bet on what exactly? Efficiency?
A bet on efficiency, yes. The core market rationale here is all about the fee compression we've been seeing for years.
From the passive products, the index funds, they just keep pushing margins down.
They do. And this acquisition shows how firms are now fighting back. The answer isn't just better stock picking anymore.
It's consolidation and tech investment.
It is. You have to get scale to lower your operating costs. And you have to pour money into technology, including AI, to run leaner than ever before. Trian and General Catalyst believe they can impose a better tech model on JHG.
And that's how they justify the 18% premium. They see efficiencies the market didn't.
That's the bet.
So the message seems to be, get big or get efficient. Or both. Let's follow that money and see who benefits, starting with the most obvious group, other public active asset managers.
Exactly. When a firm gets bought at an 18% premium, the market immediately has to reprice all of its competitors. It creates what people are calling a consolidation premium.
And is that premium just about the hope of a takeover, or is it something more?
It's mostly the takeover hope. The thinking is, if JHG is worth an 18% premium to smart private buyers, then other mid-sized firms must also be undervalued.
So investors start buying them up, expecting they'll either merge on their own or get targeted.
Yes. It puts a higher floor into the whole group's valuation.
So which specific companies, which tickers are getting this attention now?
Well, a few names keep coming up. You've got Invesco, that's ticker IVZ, Franklin Resources, which is BEN, and Affiliated Managers Group, AMG.
I also saw T. Rowe Price mentioned, ticker TROW. Now that one caught my eye. They've always been known for their independence.
And that's what speaks volumes here.
You mean the pressure is so great that even a brand like T. Rowe Price is now in the conversation?
Yes. They're not immune. Nobody is. The market now has to assume that every firm is either a buyer or a target, regardless of their history. This deal forces every CEO to reconsider their strategy.
That definitely puts things into perspective. Okay, let's move on. The private capital firms running this deal, they're not just buyers. It seems like they're positioning their whole ecosystem to win here.
Oh, absolutely. That's the second win. And it can be just as lucrative. More M&A, more restructuring. That means more business for these giant private capital platforms.
And you're talking about more than just writing the check for the deal?
Much more. Think about the complexity. It means advisory work, debt financing for these takeovers, helping with product rollouts, setting up distribution partnerships. It generates fees across every single part of their business.
So who are the big players best positioned for that kind of work?
The names that are consistently cited are Blackstone, ticker BX, KKR, which is KKR, and Apollo, APO. Their scale is just so massive they can absorb and facilitate all this activity.
Let's turn to our third group of winners. The buyers made it clear they plan to invest in technology. So where does that money go?
It goes directly to the asset management, tech, and data providers. This is a guaranteed spend.
You can't get those cost savings without better tech.
You can't, not to justify that premium. So there will be an immediate increase in spending on portfolio and accounting platforms, data analytics, regulatory reporting tools. all the back office automation.
Basically, they're realizing it's cheaper to automate than to hire more people as you grow.
That's the only way. If you go from managing 400 billion to 600 billion, your staff count can't grow proportionally. You need a common technology spine to handle it.
So which companies provide that spine? Who gets these contracts?
You'd be looking at firms that provide that core infrastructure. So SS&C Technologies, ticker SSNC, Broadridge Financial, that's BR, and MSCI for all their data and index tools. They provide the foundation.
Okay, now for the flip side, every deal like this puts pressure somewhere else. So let's look at the groups that might feel the strain, starting with custodians and fund servicers.
Right, they're facing a bargaining power squeeze. It's a very straightforward dynamic.
Because when asset managers get bigger, they can demand better prices from their vendors.
Immense bargaining power. JHG is now part of a system designed to be cheaper, and they will absolutely use that leverage to push down the fees they pay to custodians and administrators.
And for a custodian, where the business is built on tiny margins over huge asset pools, even a small cut can hurt.
It can be structurally damaging to their margins. The newly combined firm can threaten to move hundreds of billions of dollars to a competitor. That threat alone is often enough to force fees down to the bare minimum.
Which publicly traded firms are most exposed here?
This primarily affects the big servicers. We're talking about BNY Mellon, ticker BK, State Street, which is STT, and Northern Trust, NTRS. The consolidation of their clients makes for some very tough negotiations.
Okay, let's move to the second group of losers, the exchanges. Now, how does one company going private have an effect on a massive venue like NASDAQ?
It's not a crippling blow, but it is a headwind. Exchanges make money from two main things: new listings and the trading volume in those listed stocks.
And this deal takes a company off the market.
It takes one company off the board. That's a direct reduction in the number of names to trade and the total market cap available on that exchange.
So it's not about JHG specifically, but the signal it sends. If more successful firms choose to go private to fix their operations, the pool of listed companies starts to shrink.
Precisely. It works against their core mission, which is to grow the number of listed companies. So the venues feeling this are NASDAQ, ticker NDAQ, Intercontinental Exchange, ICE, and Cboe Global Markets, CBOE.
That makes sense. Okay, finally, loser group 3. The smaller, mid-sized active managers who don't have that scale. What happens to the firms left behind?
They face a real existential threat. If the new industry standard is high-tech, broad distribution, and massive scale, then subscale firms just can't compete on cost.
Their operating expenses are just too high relative to the giants being created.
Way too high. They can't afford the same level of tech investment, they can't negotiate the same deals with servicers, and they'll struggle to keep top talent.
So they're eventually forced to merge, but from a position of weakness.
Exactly, on much less favorable terms than the premium paid for JHG. Their negotiating power gets weaker with every one of these deals that gets done.
And which companies fall into that category where the pressure to do something is building?
Some of the names being discussed are Virtus Investment Partners, ticker VRTS, Alliance Bernstein, AB, and Lazard, that's LAZ. These are the firms that have to make a tough choice, and soon.
So, to sum this all up, the $7.4 billion acquisition of Janus Henderson Group is really an indicator of a broader restructuring in finance. It creates opportunities for scaled-up managers and tech providers.
While at the same time, it challenges the fee models of service providers and questions the viability of smaller competitors.
And this brings us to a final thought for you to consider.
If scale truly is the primary defense against this relentless fee pressure, you have to ask yourself, what does the next year look like for all those specialized boutique asset managers out there, the ones who rely entirely on niche performance instead of technological and distribution mass?
Thank you for joining us for this analysis. Please remember, this material is for informational purposes only. It is not financial advice or recommendation to buy or sell any security. Any opinions presented are purely those of the author who prepared the original analysis.